All right. Hi, I'm Jacqueline Jackson, Senior Portfolio Manager at the Center. Welcome to our Q&A webinar. We're going to answer your most commonly asked questions this year. And we understand that recent market volatility has been tough to stomach. We're here to help you navigate through that rough terrain. The topics we'll cover include inflation, recession, energy, geopolitical issues, interest rates, and a lot more. Luckily, I don't have to tackle these questions alone. I have my esteemed colleagues with me, Partner and Director of Investments, Angela Palacios. Hey, Angie. And Portfolio Manager, Nicholas Boga. Hey, Nick. Joining me today. Welcome, team. Thank you for being here. With that said, let's get started. Angie, before we start digging into questions, can you give us a brief summary of what's been happening in markets this year?
Sure. Well, the first half of 2022 has seen a surge in interest rates, volatile equity and bond markets, geopolitical conflict. And while investors have been recalibrating, their expectations on the Fed's timeline for interest rate increases, the economic data continues to show soaring prices and a very tight labor market, strengthening the case for the Federal Reserve to take very aggressive action to try to tame inflation. Complicating the matters even more for the global economy is China's COVID-related shutdowns. They've exacerbated, supply chain disruptions we've been seeing. And during these uncertain times, we want to highlight kind of 10 different themes, as I'm sure you've seen in the written commentary that we're thinking about. So many of these themes are at play this year. But despite, these important themes, it's really key to remember that your financial plan is the most important theme to us through all market conditions. And financial plans we design are built to withstand markets like we're experiencing today, and even worse, actually. Everyone uses kind of a different map to chart their destination. Some destinations might be a week away, some might be years away. But I want everyone to rest assured that your plan is designed with your destination in mind, and this type of volatility is expected along the way.
Yeah. So yes, we do plan for clients. But Angie, you just said a lot of things that make investors worry. And so that's kind of leading me into the big question here. Are we in a recession?
Well, no one has officially called that the U.S. is in a recession yet, but it is looking more likely that we could enter one. 2 quarters of negative gross domestic product, or GDP, is the traditional definition of inflation, one of which was already logged in the first quarter. So we're keeping our eye on that second quarter number coming out soon. And we know everyone is thinking about this because the amount of Google searches for the word recession are nearing 2008, 2009 levels. So what if we are in recession? I think that's kind of the next natural question to ask. But I think it's important to realize the average drawdown for the S&P 500 for past kind of mild to moderate recessions has been about 24%. And we nearly hit this level already in mid-June, right before we had a kind of a slight recovery coming into the 4th of July. It's been pretty choppy since. Severe recessions typically correspond with market drawdowns of about 34% on average for the S&P 500. Preparation usually needs to happen in advance of these things. Leading into this year's drawdown, we took several actions in portfolios, including rebalancing because equities had such a strong run in the second half of 2020 and through 2021. We added a real asset strategy years ago to help hedge potential inflation, and we shortened duration in our bond portfolios. If cash was needed in the next 12 months or so, we likely raised it for you, or we had those discussions with you.
Yeah, thank you for pointing that out, because yes, we really have been thinking about these things and trying to make sure portfolios are robust in these circumstances. So thanks for highlighting the things that we're doing. And just to, reiterate, so the definition of recession is 2 successive quarters of negative GDP. We've had 1 negative quarter, which was the first quarter. And essentially, we're kind of flirting within recession ranges, but we're not quite there at this point. So yes, it is. I get why people are worried about it, but we have to wait and see on this one. Now, we have midterm elections coming up in the United States, and it seems to me that politicians tend to sensationalize recession rhetoric in economic and market environments like this one. And as a result, voters are bombarded with recession-dominated messaging, which tends to exacerbate anxiety around it. Maybe that's just me, but I tend to find that with politics. Can you speak to the center's philosophy around politics and investment decisions? Because that's another kind of big topic type of questions that we've gotten from clients.
Yeah, definitely. I think, the short answer is no. I don't think politics should mingle with your investment decisions. They're a very polarizing and emotional topic, no matter the side you're on usually. But I find it best for investors to kind of separate those emotions from their investment decisions, as difficult as that can be at times. This is one of the biggest reasons, a financial planner plays an important role in the long-term success of a plan. We help you kind of take the emotion out of investing. And besides, companies usually find a way to innovate and be profitable regardless of political party agendas.
Yeah. Now, Nick, I want to bring you into the conversation. So Angie talked a lot about our domestic landscape, but I want to pivot to our international landscape. So you and I, we did a blog series in late May and early June about portfolio diversification. And so in the first part of the series, I focused on the merits of diversification, but in the second part, you specifically talked about international diversification. The blog series was largely in response to another question that we've gotten this year, which is essentially, should we dump our international investments? How would you respond to that question?
I would respond shortly with a no, but here comes the long answer. So US large cap stocks have been the darling asset class of the past decade or more, which has tempted many investors to ditch their other asset classes in favor of more US stocks. But as 2022 has shown, there's a big risk in concentrating your investments into one single asset class, especially if that asset class ends up being one of the worst performers of the year. So it is especially risky to load up on a single asset class after we've already seen a vast period of outperformance like we've seen in the US stock market over the past 14 years. I think this chart from JP Morgan's Guide to the Markets really kind of lets you visualize that cyclicality of the outperformance. And you can see we've been on this 14.5-year run of US dominance. So loading up at the end of one of these long cycles is especially risky. Another reason to hold on to your international investments is that global valuations are much cheaper than they are here in the US. And studies show that lower valuations tend to suggest higher returns going forward. And another good chart here that shows that the US has not always traded at a premium to global stocks. It's from GMO. They have a great chart showing the cyclicality and the long-term history of global stock market valuations. And this chart here is a couple years old, but the gap remains, and it's actually even the gap between international and US has actually diverged even more over the past couple of years. But you can see historically, developed has traded more expensive valuation than US has. So the US demanding a premium has really widened over the last 10 years. And that's another reason that you might want to hold on to your international investments. Lastly, to quote one of our international investment managers, Granger Peak, and they actually used a quote from Howard Marks that is over 30 years old, but it really resonates, especially to this question of the US versus international investments today. Howard Marks said, the mood swings of the securities markets resemble the movement of a pendulum, although the midpoint of its arc best describes the location of the pendulum on average. It actually spends very little of its time there. Instead, it is almost always swinging toward or away the extremes of the arc. But whenever the pendulum is near either extreme, it is inevitable that it will move back toward the midpoint sooner or later. In fact, it is the movement towards the extreme itself that supplies the energy for the swing back. So that really speaks to the cyclicality of the outperformance in US and international. Lastly, the final point on diversification, and Jackie touched on the benefits of diversification in her blog. So I encourage you to find that blog back on our website. But diversification has been a success story even through a hard 2022. Almost every asset class is negative year to date through the second quarter. And this final chart from JP Morgan really shows the pain across many asset classes. You can see here, year to date, that commodities is actually the only asset class that is overwhelmingly positive year to date. Everything from bonds to stocks to real estate to international, large and small are all negative. The success story of diversification comes that if you hold this asset allocation portfolio, which is just a diversified set of many asset classes, you're not down as much as you are with some of the more volatile asset classes of the year, including US stocks, small cap stocks, and international itself is actually down less than US this year. So diversification is a core principle of the center's investment process, and that makes international stocks, diversified bonds, and other alternative asset classes key components of our portfolio going forward.
Awesome. So I'll let you guys on a little secret that's not so secret. Nick likes his charts and graphs. So thank you for sharing that with us, because they were really helpful in illustrating how the center feels about diversification. And I think right along the lines of that, obviously we can't have a Q&A without talking about Russia and Ukraine. That is also one of the popular questions that we hear is, how is Russia and Ukraine impacting my portfolio? So I'll tackle that one. Essentially, there's really at this point no resolution in sight. So it's one of those, we're kind of seeing how things pan out. We've noticed that the headlines have kind of died down in the news, but there are still some implications that impact your portfolio. Now, to be honest, speaking of center philosophy, we don't recommend you making changes based on headlines. Again, headlines are something that are short term, and we are here for long-term investors. So we do not advise people making changes based on that. But there are some impacts because it has been so much so in the headlines. So we understand that, yield curve inversion, rising interest rates, all these things are contributing to market volatility. And the combination of these things, along with our indicators, have kind of triggered us to take caution and to slow things down a little bit, because there could be some more risk on the horizon. So the market has shown to be really fragile with news, unfortunately, but that's a case. So because of this, where it's appropriate for clients, we've added a bigger allocation to money market investments for the time being. Now, Angie, in terms of Russia and Ukraine, another big part of that is rising oil prices. We know Russia's relationship to oil, and we can see how that's been impacting the cost of energy. So another really common question, what are the implications of rising oil prices for investors?
Well, I think looking just beyond inflation, and we'll talk about that later in more detail, energy really has been by far and away the best performing sector in the market, the S&P 500. That doesn't necessarily mean it's going to be the best performing sector going forward. Usually by the time something's making headlines like gas prices are, right now, the returns have already been booked. However, looking ahead, kind of this bout of higher gas prices might do more to spur the country toward utilizing more renewable resources. And it's probably more effective than any lobbying group or politician could hope to accomplish on their own. As fossil fuel prices continue to rise, it makes alternative fuels more cost effective, comparatively so, and can accelerate, the adoption by our population. So this may translate well for those investors who are focused on ESG strategies. In general, you should see markets responding favorably to lower oil prices as well going forward if that starts to happen, because that'll translate to lower inflation, which could mean the Federal Reserve might be able to slow down their course, of rate increases. So it's kind of a domino effect that it can have on the economy.
Yeah. And, we have a dedicated ESG strategy for anyone who's interested in the long-term play that Angie is talking about. Nick, I want to shift gears a little bit and talk about an investment product that we don't provide, but it's really grown in popularity over the years, and that's cryptocurrency. You've been doing a lot of tracking and blogging and research around this topic for our firm. So can you share what's been going on in the cryptocurrency world?
I can. No charts for you this time, though, Jackie. Because cryptocurrencies have definitely continued to make headlines through the first 2 quarters of this year. Only this time the headlines are related to the meltdown that has kind of been happening. Last year, many touted cryptocurrencies as the only true inflation hedge until they weren't. There are many narratives that might drive crypto prices, like inflation hedge or correlated to stocks or whatever you want to, whatever story you want to tell. But I think you really have to think of cryptocurrencies as their own separate beast. And in the past quarter, most cryptocurrencies have dropped more than 50%. Coinmarketcap.com is a good one that shows the total market cap of all cryptocurrencies, and that actually reached a high point last November of almost $3 trillion. At the end of this quarter, that number had fallen to $850 billion, which is a 70% decline for the space as a whole, which is a huge crash. And some individual cryptocurrencies have fallen over 90% just this year. So it's a risky space, and speculation and volatility are and will continue to be a hallmark of this kind of asset. So we urge you to proceed with caution if you're doing so on your own.
Yeah, thanks for not charging me, Nick. My Bitcoin's down, so I couldn't pay you anyway. Obviously, I'm just joking there. I definitely second your thoughts. Proceed with caution for people who are participating in cryptocurrency. You could see it's extremely volatile, so proceed with caution. Now, I want to get into the number one question that clients have asked. And Angie, I'd like you to address this question. We felt it at the gas pump. We felt it at the grocery store. We've seen it in our bond portfolios. What happens if inflation persists?
Yeah, it's a good question. Inflation has been much more persistent than anyone anticipated coming into this year. Government stimulus money is still sitting in bank accounts, kind of driving our desire to purchase, hasn't been fully spent yet. I have started to notice that inflation is leveling off at least. Early indicators are pointing to some potential relief. I don't know if you remember the chart earlier in the year at our last investment presentation that I referenced, but it showed over 100 container ships waiting outside of LA and Long Beach, California, one of the biggest ports in the country. And that was causing, supply chain, or contributing to the supply chain disruption, which was also causing inflation. Well, that number's down to 34 as of May. So we're seeing delivery times are way down, but then you still have things like chip shortages that continues to hurt many different industries, automotive included, which is a big one. But we have seen US core PCE, which is inflation, but leaving out energy and food prices, has fallen by about 20 basis points year over year. So it's its third consecutive monthly decline, so that we are starting to see some potential signs of easing inflation out there. But getting back to your question of what happens if the inflation persists, there's no free lunch out there. Enduring volatility is why equities provide returns that outpace inflation. So maintaining exposure to equities is very important for your financial plan to endure that inflation. And I now have a chart to share with you.
Nick, you got a friend.
Charts.
You got a friend, Nick.
You can see on this chart, looking back over time when we've had periods of inflationary pressure, which we have back in the 70s mostly, equities provided that best long-term return to kind of keep pace with or exceed inflation. Inflation's the green line you see there at the bottom. It's been very low for very long, but there have been periods where it accelerated more quickly. Equities are the orange and kind of black or dark green, depending on how that color comes through. So you can see they've, over time and pretty consistently well outpaced inflation. I have one more chart to share as well. Did you know that emerging market equities have historically been, some of the best performers during periods of high and rising inflation or periods of high and falling inflation, we've been in this scenario. We're probably moving more over to this scenario, but there aren't a huge amount of times this has occurred. So statistics might say it's not statistically significant enough, but it's what we have to go on. And emerging market equities have been the clear winner, but you can see in general, equities have been kind of very helpful during these time periods, as well as like REITs and commodities. So that's why, it's important, to keep your allocation there, even though things might be volatile. Sometimes we get questions regarding gold, and we have held positions in the past in gold. It helps more during the surprise when inflation kind of first strikes, but not as much as inflation drags out, and hasn't quite helped maybe as much as investors had hoped this year. But gold and precious metals, tend to help again in those early inflation surprises, but tend to be less helpful to offset inflation over long periods of time.
Yeah. And what you're saying really relates to what Nick and I were discussing before about portfolio diversifiers. The short of it is that they're important. And for those clients who have been pulling their hair out over our emerging market investments, there's some method to the madness, right? And that's precisely why we don't want investors to have all their eggs in one basket. And I know we have domestic bias, but we don't want to have everything in the U.S. Stock basket. We need to broaden our investments to dampen risk. So speaking of diversifiers and things that are not supposed to have much correlation, Nick, you support research for our bond positions, and right up there with the inflation question is this one: should we continue to own bonds as rates are rising?
Yes. The short answer, yes. The long answer is no mystery that it's been a very tough year for bonds. Maybe one of the worst years in the past 100 years for bonds even. But it's likely that the worst is over, as there are some hefty rate increases already built into the bond market's current yields and prices. And with that, bonds are also paying higher interest rates, making them a little bit more attractive. Also, as rates rise, duration risk comes down as yield is a part of that duration equation. So bonds are still an important part of portfolios as they best offset equity risk. So that's one of the biggest reasons to hold bonds, and one of the biggest reasons that the short answer should be yes still. Shorter duration bonds, like we have added over the past couple of years, help during bond market drawdowns like we've experienced. And while we're still taking the stance of don't fight the Fed and keep duration low, as interest rates rise and duration falls in the bond market, we will look to add more duration risk in portfolios to increase yield.
Yeah. So hang on to those bonds. Now I want our director of investments to address this last question. You get the heat, Angie. That comes with the leadership. And this is honestly, it's not actually a question. It's more of an impulse. When markets are volatile, investors feel this irresistible urge to scratch the itch of doing something. So I have a two-parter for you, Angie. What do you say to investors who are itching to do something? And what has the center been doing to manage portfolios in this environment?
Yeah, that's a really good question. We do get that one a lot. Investors do often feel the need to do something when markets are volatile. And we have that fight or flight instinct that kicks in. It's been ingrained in our systems for thousands of years. And it's important that if you are doing something, you make sure that it's the right thing to do, driven by the right reasons. As doing the wrong things over time can be very costly to your long-term financial success. So if you feel the need to do something, please let us worry about that and kind of coach you through that process if you need that. We have been busy behind the scenes doing things like tax loss harvesting. You've probably seen a fair amount of this if you have a taxable account with us. Thinking about timely Roth IRA conversions, if that's a financial planning strategy you've been working on with your planner. We're, of course, rebalancing as always, making sure cash needs are met. So those are many things that we've been doing. We monitor factors that may tell us, when to lighten up on or add to equities as well. And while these factors really are meant to trigger rarely, as there is kind of a shift in incoming information from our broad set of barometers that we use, there may be changes from time to time in our outlook and strategy. And we have seen that recently with the shifting a little bit away from risk assets because of the volatile nature of markets recently.
Yeah. And, I'm really happy you mentioned that, because I want to make a distinction here when it comes to doing something. So investors, they often hurt themselves when they're reactive, right? But they help themselves when they're proactive. So I'm really happy you were mentioning a lot of those things that we were doing. So for example, we proactively put clients in a position to weather market conditions. And one of the first things we do is make sure they have enough cash reserve in their portfolios to pay annual living expenses without being tempted to sell off their portfolios at the worst time. As mentioned before, we use portfolio diversification to mitigate long-term risk. And I'll admit, it doesn't always work short-term, but in the long run, it truly helps mitigate risk and uphold portfolio integrity, especially during the years retirees take withdrawals. As you mentioned, Angie, we tax loss harvest and rebalance regularly so that clients are able to take advantage of volatility and invest at a discount. And I can keep going with this, but the key here is that even though markets are challenging right now, we're constantly strategizing before market events occur to support your ability to make it past the turmoil and ultimately meet your investment goals. That's very important to us. I'll get off my soapbox now. With that, I think we hit all the common questions that we've received so far this year. Of course, for anybody watching, if you have additional questions, we're here to help. Thanks, investment team, for helping me answer the questions. And thank you all for tuning in. Enjoy the rest of your day.